Hey, what's up YouTube? In this video, I'm going to talk to you about the 4 fundamental characteristics that you want to have when you're thinking about investing for your future and where you want to put your money. These 4 things are critical. Some of the investments out there, some things have some of them, 1, 2, or 3. Some of them have all 4. I recommend that you look for the ones that have as many as possible and preferably the ones that have all 4 of them. My name is Cluff. I'm a financial coach and I love helping people manage, protect, and grow their money. And we're going to get right into the 4 fundamental characteristics that I look for when I look at investing where to put my money. The first one is liquidity. Now, liquidity is key because if anything was to happen, you're going to want to get access to the money. One of the things, as an example, that a lot of people will put their money into is a 401k or an IRA. Well, there's penalties if you take that money out before a certain age. That, to me, is a limit or a barrier to liquidity. Another place that people put a lot of money is in a CD in a bank. Well, they'll tie it up for 6 months to a year or more. That is, again, a barrier to liquidity. Savings accounts have great liquidity. Mutual fund accounts, brokerage accounts have great liquidity. If you need to get access to the money today without penalties or without any strings attached, could you get access to it? That is liquidity. You want to be able to have access to your money in case of an emergency, in case anything comes up. Liquidity is a key characteristic of making sure that you have what you need. The second characteristic is safety. Safety not only of your principal, but safety in the institution in which you're investing. So a lot of people will put money with this great new idea, oh, this new institution, this new crypto, this new whatever came out, let's put our money over there. If it's not been proven over a very long period of time, it's probably not safe. So don't put your money that you need to keep safe into that kind of a location. Another thing is you're investing. The stock market is very volatile. So that's not necessarily a safe place unless you know exactly what you're doing, unless you're doing what you're doing. You know, safety can be increased through our due diligence and through understanding and knowing what we're doing with our money. Again, another key element to safety is making sure that not just where your money is invested. For example, there was a lot of people that invested in a certain crypto exchange not too long ago, several years ago, and that crypto exchange completely went out of business and everybody lost money. A bunch of people invested money with a guy named Bernie Madoff, and he made off with all their money. So that was not very safe. So making sure that you have safety with where you're putting your money. Now, there's some money that you want to be speculative with, and that's fine. And the risks and the reward ratio can be, whatever you need it to be. But that foundational long-term money that you're going to really count on and rely on, you want it to be safe. So the first thing is liquidity. The second one is safety. The third one you want to get is rate of return. Now, a lot of times you might start to think, Paris, the only way I'm going to get a good rate of return is if I really get into the market, and the market isn't as safe as some of these other locations. And sometimes I have to put it in retirement accounts, and retirement accounts aren't as liquid as they can be or should be or could be, or some other things are. So how do I get liquidity, safety, and a good rate of return? Well, there are things that are out there that do that for you, and we want to get a good rate of return. There's something called the rule of 72, which tells us that whatever interest rate we are earning, if we divide that into the number 72, that will tell us how often our money will double at that interest rate. So if you're earning 1% at the bank, it's going to take you 72 years for your money to double. So if you had $1,000 invested at 1%, in 72 years it'll be $2,000. Probably not going to be the place you're going to want to put your money to retire. If you got money earning anything less than inflation, you're probably doing it. Well, that could be, there are places and reasons why you should put money in places that are earning less than inflation. But if it's your long-term money that you're planning to retire on and use in your golden years, you're going to want to make sure you're outpacing inflation by several percentage points. Inflation usually averages 3 to 4%, so you're going to want to definitely get somewhere in the 7, 8, 9% range, and that's very possible with a lot of places and places that have liquidity, safety as well. So there's the third one, is getting a good rate of return. You want to make sure that you're earning at least market returns, 7, 6, 7, 8, 9, even double digits if possible. And it is possible. And so making sure that you get a good rate of return is critical, especially the younger you start, the more it has chances and time to double. And the more doublings you have, the more money you'll have when you need it. So the last one is tax advantages. You're going to want to have tax advantages. Tax advantages are, a lot of these retirement plans have tax deferral. Tax deferral is when you are going to pay it later. So it's deferred while it's accumulating or growing, and then you pay it later. There's tax free, which is like a Roth IRA or life insurance retirement plans, things like that. Those are tax free. You can put money in there. Once it's in there, it grows completely tax free. It means it's deferred, and when you pull it out, it's also tax free. So you want to make sure you have liquidity. You want to make sure that you have safety. You want to make sure you have a good rate of return, and you want to make sure you have good tax advantages. Now, are there great tax advantages just with a brokerage account? And certainly there can be. Long-term capital gains is much better than earned income taxes, that's for sure. It's a much lower rate. So there are some advantages even just having a regular brokerage firm. But at what level of advantage do you want to go for? Do you want to have long-term capital gains, which is just it's still taxed, it's just a lower tax rate? Do you want to have tax deferred, where it gives you a discount today on your taxes, but you're going to have to pay full price on your taxes later down the road? And between you, me, and the wall, I don't know what's going to happen with the government, but I'm predicting that the future tax rates are going to be a lot higher than they are today. So you're going to want to get more like the tax-free side of things, which is tax never again. I also call it tax never again. You pay the taxes on it when you receive it as income, and then you invest it in a place that will grow tax deferred and tax-free when you pull it out. One of the things that I like about these tax-free vehicles is that I can literally say when I turn 65 and I'm in retirement, depending on how many assets I have with these tax-free locations, I may never have to file taxes again, and that would be awesome. Or maybe I can file very little because most of my income is coming from these tax-free locations. So liquidity, safety, good rate of return, and tax advantages. So let me just touch base really quickly before I end on one thing that I wanted to talk about is the FIRE movement. The FIRE movement is a great opportunity for you to what is called financial independence, retire early. If you use a traditional retirement account, meaning like a 401k, 403b, IRA, anything like that, even a Roth IRA, frankly, which has got great tax advantages, you're going to have and run into the liquidity problem. If you want to retire at 40, the rules are you have to pay a penalty if you retire anything before 59 and a half on all of those accounts. So making sure that you have your money in tax. So where do you put your money if you want to retire early? That's going to be the key element. If you'd like to know more about what I'm doing or what I'd like to do, make sure that you reach out to me at pariscluff.com and frankly, download my ebook and get on my distribution list, my email list. I have a newsletter that I put out every week. So if you go to pariscluff.com/free book, not only will you get the ebook that I produced that helps you put several $100s back into your paycheck, back into your bank account every month, helping you find money you already have in your budget that you're misspending, and really get disciplined on your spending. You'll also get access to my newsletter, and you'll be able to have an opportunity to keep in touch with me and learn some of the things that I'm doing as I'm trying to be more liquid, more safe, get better rates of return, and have the best tax advantages possible. I hope that you take time today and over the next couple of weeks to turn your income into wealth, get better at turning your income into wealth, and so you can build a massive bank account. Have a great day, and we'll see you on the next one.